Hey everyone, I recently completed trading SPY Strangles for 365 days, and today I'm going to show you the results. I will show you the adjustments I had to make and the rows that I had to make on the way. So stick with me, it's quite exciting and I'm confident that you will find it useful. So let's get straight into it. So first of all, let's talk about the strangle. What is a strangle? So strangle is an option trading strategy where you sell a call option and a put option at the same time. And what you're hoping to achieve is that the share price indicated with this blue line in here will remain between your two strikes. So let's assume that this particular stock started at $100 and then it went down to, let's say, 90, and at that point you decided to sell a $80 put option and a $120 call option because you were a little bit bullish on this trade. And what you were hoping for is that during this period, or when you were planning to close these options, the stock would be between your two strikes. So that's how you can make money trading strangles. It's quite a lucrative strategy, and as you can see, it doesn't matter which way the stock moves, you can profit from this strategy. So like I said, I traded strangles on SPY for 365 days, and on this slide you can see the candlestick chart that shows you the SPY movement as well as my positions. So I started on the 20th of May 2022, and you can see that I initially sold the 350 put option and the 420 call option, and then as the share price, in this case SPY, went up, I needed to make adjustments, so I rolled on the 27th of May. Rolling means that you have a particular expiration and you roll to the following expiration. In other words, let's say your original position is about 20 days, 21 days to expiration, and at that point you buy back your positions because initially you sell these positions when you trade options normally. And when you buy back these positions, you basically close that position entirely, and then you reopen another one by selling another call option and another put option. So as you can see over here on the 27th of May, because the SPY moved up a fair bit, I also moved up my put strike and my call strike. So I waited another month or so. On the 27th of June, I rolled again to the following month. But during that period, I had to make several adjustments. That's why you can see that, for example, my put option, which is the blue line, it kept on going up because I needed to get it closer to the actual price. And every single time you make these adjustments, well, if you do it right, then you collect additional premium. And that's the whole objective with trading strangles. Now, with my call option, I remained at the same level for a period of time. And then as the market started to collapse, I had to roll down my call option and I collected additional premium. Over here, you can see that the SPY broke below my put strike. That can easily happen on the call side as well. And when this happens, then basically all it is that you just have to stick with your strategy and hope that eventually the share price is going to bounce back and go between your two strikes. So like I said, on the 27th of June 2022, I rolled again, and during this period I didn't need to make too many adjustments because the share price remained relatively stable between about 370 and 390, and then I only needed to make really a few adjustments. And then moving forward a month later, so as you can see, I keep rolling more or less in about every 30 days. And so over here during the period of July, August, the SPY was skyrocketing, going from 370 all the way to 430. So that was a fairly challenging period for me personally because I was breached on the call side. So I had to make frequent adjustments once again on the put side. One thing that always works to option traders' advantage is the time decay. So as time goes on, the option values diminish. But in this particular case, my call option value went up. So I was eager to roll again to the following month. And you can see that with every roll, you can widen your strikes. I was pretty close to have the call and the put strikes at the same level, which is called a straddle. But fortunately, it was time for me to roll, so I was able to widen my strikes a fair bit and move away from the actual price. And after that big rally, the SPY went from 430 all the way down to 350-ish. So this time, instead of doing a lot of adjustments on my put side, I had to make a lot of adjustments on the call side. On the 4th of October, I rolled again. I widened my strikes and I was able to collect additional premium along the way. And if you remember the first 9 months of 2022, it was a very challenging period with a lot of fluctuations. And you can see it over here. The SPY was just going absolutely crazy. On the 4th of November, I was able to roll again, widen my strikes, and unfortunately, the overall market started to calm down and I was able to make less and less adjustments and stay a healthy distance away from the actual price. And that's the ideal situation. Like what you can see over here, going from November all the way till the end of my 365-day period. This was beautiful. I was able to collect a lot of premium and stay away from the actual price. As you can see over here, we had several days of no adjustments whatsoever. And that's the best because that's when the time decay is really in your favor and you're not being tested on either side. So now let's take a look at what the VIX was showing during this period. As you recall, the beginning of 2022, we had a very challenging period. The overall risk in the market was relatively high. The VIX went all the way up to 35. For those of you who don't know what VIX is, VIX basically measures the market, the overall market volatility. So when it reaches 35, that's quite high. Normally it's between 15 and 18. During the GFC, the VIX went significantly higher than 35, and also during the COVID shutdown, the VIX shot all the way up to 80 plus. Now that's extreme. That's when the market was just tanking. Now when you sell strangles or when you sell options in general and the volatility starts to come back down, then that actually works in your favor twofold. On the one side, the time decay is always in your favor, but on the other side, when the volatility drops, then the option values also drop. So it helps you in two ways when you sell options and the volatility diminishes. Around September, October, the volatility once again went up, and that was the period when I was heavily tested and I had my call and my put side at the same level while the SPY was much lower. So that was a stressful period, but at the end of the day, if you stick with your strategy, eventually it will work out. So you can see that as the volatility was going down, I was able to stay further away from the actual price, and that's the ideal situation. Over here, you can see that volatility went up to 26, 27-ish, and at that point, my strikes were a little bit closer to the price of SPY, but then volatility dropped again, and I was able to stay at a safe distance away from the underlying. Now let's take a look at my delta position. So for those of you who are not familiar with what delta is in relation to options trading, delta basically gives you an indication as to how much the option price is likely to move when the underlying price moves. So if the delta is 50 and the underlying price moves $1, then the option price is likely to move about 50 cents. It's also a great probability indicator. It gives you a fairly reliable indication whether your option strikes are going to be breached at expiration. When you trade strangles, what you normally want to achieve is a relatively neutral strategy. So over here you can see that I started with my strangle with zero delta, which is very much neutral. That means it doesn't matter which way the underlying moves, in this case SPY moves, my strangle will be affected exactly the same. When your delta is a positive figure, then it's a bullish strategy. And when your delta is a negative figure, then it's a bearish strategy. You can see the relationship between my position, the underlying, and my delta. And you can see that in most cases, I was a little bit more on the bearish side because I just didn't trust the market. Now, over here, when you see that my delta went up, that's purely because my put position was heavily tested. In fact, it was breached. So the underlying went way below my put strike, and I ended up unintentionally very bullish. But then as I rolled to the following month in November, I widened my strikes. I brought my delta back to more or less bearish territory. And that's pretty much what you need to do when you trade strangles. You just need to try to keep your delta around the neutral territory, because that's when the underlying is more or less in the middle between your call strike and your put strike. But of course, it's not always the case, because in some instances the market is expecting a particular stock to go up, and that would be reflected in the option prices. So if you sell a call option and a put option exactly the same distance away from the underlying price, then doesn't necessarily mean that your delta will be exactly zero. But that's a topic for another video. I'm not going to go into much further detail into that. But what you need to take away from this slide is that when you trade strangles, especially on ETFs like the SPY, then you do want to maintain a relatively neutral stance on your positions to make sure that your strikes are not going to be breached. So now let's take a look at how much premium I collected over the past 365 days trading strangles on SPY. So as you can see, when I first started on the 20th of May 2022, I collected roughly about $500 worth of premium. And then, like I mentioned, every time you roll, what you want to achieve is you want to get additional premium. So that's how you can grow your premium. But then in some instances, like over here, I was way too close to the underlying and I needed to go much further away. The volatility was high. So when I rolled from one month to the other, then I decided that it was safer for me to sacrifice some of the premium that I collected so that I will have a much safer position. And the same thing happened in here. My put strike was heavily breached, and when I rolled to the following month, I widened my strikes. I sacrificed a significant portion of the total premium that I collected just so that my strangle is in a much safer position. This is not ideal, but sometimes you do need to do this depending on the market conditions. What's ideal is what you can see over here from mid-November. My premium just went up and up and up all the way to roughly about $3,700. That's what you want to aim for when you trade strangles. On the bottom of this slide, you can see the capital required. So initially, I needed about $4,500 capital, and then it went all the way up to roughly about $8,800 when the market volatility was very high and I was breached on the put side one day and then breached on the call side the next day. So that's when the capital requirement was pretty high. But as soon as you widen your strikes, then the capital required drops. And we can safely say that if you want to trade strangles on SPY, then you do need to have about $10,000 minimum in your trading account just to make sure that you have enough buffer. Now let's move on to the most interesting and most exciting part, which is the bottom line. So the total number of trades or adjustments that I had to make over the last 365 days was 84, and the total profit was just over $3,300. The average capital required was $7,350. And if we compare the profit to the average capital required, then the ROI is just over 45%. I like to do my calculations using more conservative figures. So I also wanted to understand, what if I look at the max capital required, which was 8,500, then you can see that even with the max capital required, the ROI was 39%. So what does this mean? If you invested $8,500 over the last 365 days and copied exactly what I did, then you would have generated 39% ROI on your money. Let's compare this to the overall market. So during this same period, the SPY went up 7.4%. So as you can see, it's a tremendous uplift compared to the overall market. And if we look at the QQQ, which is the Nasdaq ETF, then that went up 16.6%. So even against the QQQ, the performance was significantly better. I also like to just have a little fun with the numbers. So imagine if you invest, let's say, $10,000 for trading Strangles on SPY and you manage to produce 39% annually, then after 10 years, your $10,000 would become just under $270,000. So that is a tremendous return. And that's because of the exponential growth that you can achieve. So if you take a look at the $3,300 profit, let's say you break it up by 10 months, that's $330. So if you generate, let's say, $300 on month one, then the following month you actually have an additional $300 in your account that you can trade with. So I hope you find this useful. I hope you find this inspirational. And if you want to learn more about Strangles, if you want to learn more about options, then watch some of my other videos. I also did another video about a month ago in relation to trading Strangles on QQQ. I suggest you take a look at that one as well so that you can compare the results between my QQQ Strangles and my SPY Strangles. And if you have any questions or comments, feel free to reach out to me, and I'll see you on the next video. Thank you for watching.